what the death of the US dollar looks like. Now, you've seen headlines for years now talking about the death of the dollar. The US dollar is ending, they say. But maybe it's not just happening just yet, and there's 3 reasons why. So I'm going to be joined with a special guest today, someone who's been back on the channel multiple times to break down what the death of the dollar really looks like. What 3 components have to be there in order for a new one to pop up. What we should be watching for, and then we'll get into some other stuff. We're going to talk about which countries might have the best alternative, and then we're going to talk about the Fed, the US Fed, what they're doing with rates, what's happening with the US dollar here at home, what you should be expecting in the stock markets, the economy, and yes, even with your real estate, if you're hoping to buy a home or potentially refinance with lower rates. We have it all here with Nik Bhatia, a returning guest to the show. It's a great conversation. Let's go ahead and just jump right into it. All right, Nik, thanks for joining me today. Back again to the show. I think, I don't know, two or three times. Always love talking to you. Thanks for taking the time.
Thanks for having me back, Mark.
So, I love the work that you do, the book that you've written, Layered Money. I reference it often. Everyone should check out that book, Layered Money. And also the Bitcoin Layer, the news layer you've been writing. I was talking about before we started recording how impressed I am with how well of a job you've been doing. So everybody listening, check out his newsletter, the Bitcoin Layer. And what we're going to be talking about today is something that he wrote about on this and something that I've been working about in some other research that I've been doing as well. And so let's see where this matches up. And for everybody listening, we're going to be talking about the death of the dollar. Now, we've been talking about the death of the dollar for a long time, and as Nik points out, it has been dying for a long time. But the article that he put out says that the reports of the dollar's death have been greatly exaggerated. So you've heard me talking about the death of the dollar. You've heard thousands of other people talk about the death of the dollar. And he's here to say that it's been greatly exaggerated because the U.S. dollar is deeply entrenched in global financial plumbing, and the notion that China, Russia, BRICS, whatever could dethrone it is far from reality. That's what you said, Nik. So frame that up for us.
Yeah, it's really, there are 2 sides of this coin, Mark. One side is the fact that we have 30 trillion in debt. We're well above 100% debt to GDP. And historically for nations, that has been a danger zone, right? It's something that we talked about together when we were in person last year. It's on front of mind, I think, for Americans that understand the implications of that. That's one side of the coin. The other is that the dollar is entrenched, and it's in a position that is so interwoven into how we do business that unwinding the current dynamic of a dollar-centric financial system it's not a viable project yet. Even though we have different nations dreaming it up, let's say, the actual process of unwinding the dollar at the center, it's nowhere to be seen. And so those are the 2 sides right there. It doesn't mean that people and nations aren't preparing for it. They definitely are, and they're making plans. But those plans being put into action and those action items actually getting traction in global payments and international finance, that is either in its infancy or very early stages. So that's how I see it. And I don't see anything imminent, meaning in the next decade or 2, that would unwind the dollar system. And so how, making predictions, any long-term prediction really has to be taken with a lot of considerations, asterisks, but that's generally the way that I see it, that over the next couple decades, it's just not going to unwind fully.
Okay. And so I often like to say it's a process, not an event. We know that when the dollar took over the reserve status of the British pound, it was about a 30-year process. So kind of to your point, a couple decades, 30-year process. And of course, in one of the charts you used, the pound is still, I think, a top 3 currency used today. So even though it lost its status 100 years ago, it's still the top 3 currency. But let's back up just a little bit, and let's take this down to a first principles level so that everybody can start to build their own ideas off of this conversation that we're having here. So you wrote the book Layered Money, which takes everybody through the history of money and helps them build that, right? And so if we look at the dollar, the dollar as money, right? So we're talking about the dollar losing its status as money, money being a medium of exchange, so we're using it to exchange for goods and services, and also a store of value, where we store our wealth in it, and also maybe as a payment network where we can facilitate payments across the world. So if we're talking about the dollar and this global homogeny, this payment system, would those be 3 of the buckets that we're kind of talking about there?
Yeah, generally speaking, yes. And when I think about the replacement of the dollar for any of those 3, there's no clear challenger and there's no clear number 2 for any of the use cases that you're describing. I think right. Bitcoin has claims to try to fight its way over the long term on maybe all of those notes that you hit there. But as of where it stands today, neither the Chinese renminbi, the euro, or Bitcoin are really a legitimate challenger to the dollar in those aspects.
Right. So when I think about if we kind of break those 3 down, and I think it's just helpful as we kind of go through some of this, but if we kind of break those down, we look at like a medium of exchange. So nobody wants money, right? What we want is the goods and services that money buys us. So it's that medium of exchange piece. I don't want a Chuck E. Cheese token. As a matter of fact, I may not play games there because I don't want to get the tokens first, but I might get the tokens in order to play the game. And then there's a store of value piece, which I think most people at this point realize they probably shouldn't store wealth in fiat currencies. So I think that most people have already kind of gotten past that. And then there's the payment network, and I think that's a big piece because of the way the banking system is set up, the financial plumbing, as you call it. So those are kind of the 3 pieces that we're talking about. Now you said, quote, unless we experience the complete abandonment of all existing financial plumbing, it's here to stay. And so really in that quote, you're talking about the dollar being this payment network of the world, right? It's so entrenched that there's just really no way to just kind of up in that. The network effects maybe are too strong.
It comes down to, the credit component of the dollar, what I'm describing there in that sentence. Okay. It's more the capital market side of it, Mark, when we're talking about plumbing. It's not payments per se. Payments use the dollar rails, right? If we think about global payment solutions that are helping people transfer dollars across the world. But what I'm talking more about is how credit gets introduced into the market, right? How is money created? It's created in the dollar denomination because of something that we call maturity transformation. This is the idea that you have people's savings that are allocated to very safe investments, right? We think of them as money market funds or short-term fixed income, treasury funds, those types of instruments, okay? Those types of instruments have a very short maturity, right? This is money that people know they're going to get back tomorrow. Then you have in the capital market a desire to borrow money for 5, 10, and 30 years at a time by corporations and by governments. Because those governments, they don't want to have to roll their debt every day. They want to borrow money for a long time and invest in a project. And let's say a toll road, that will take 30 years to pay itself back. So they want to borrow money for a long time. So how do you match the short-term money with the long-term desire to borrow and spend and invest and build? That process is called maturity transformation. It's done largely through the repo market, where short-term money finances long-term bonds at the asset manager level or the bank level. And that maturity transformation happens in dollars. And that maturity transformation is how the world builds things and invests in long-term projects. That's the plumbing that we're talking about. That's done in dollars because both sides have agreed that that's the denomination that is coming with the savings and the short-term demand for safe assets. And because we have that base, we have companies and countries willing to borrow in dollars. It doesn't matter if it's the United States. Every company that's a major player participates in the dollar capital market so that they can participate in the maturity transformation that the dollar savings glut has to offer. So that's what I'm describing about plumbing, and that's why it's so deeply entrenched. There's nothing that unwinds that on a short time horizon. And there's no actual challenger in that regard for the maturity transformation. And so that's why I don't see a competitor coming for the dollar anytime soon.
So you're talking about the liquidity, or not just the payments markets, but the credit markets. And so the majority of loans being done are denominated in dollars. And you need the differences in maturities and links and the liquidity available in those markets for sovereigns and whatever to be able to borrow, and there's just no replacement for that.
That's correct. And if you think about who is investing in these long-term projects, not the core here to understand the maturity part is that not all players in the dollar market want to lock their money up for 30 years. They finance that activity through the repo market, and it's just a matter of borrowing money and then investing that money at a rate that's higher than the amount that the rate at which you're borrowing. So that's called a spread or a positive carry, where you borrow and then you invest and you try to target a difference that's positive so that you're making a net interest on that activity. That is done in dollars because both sides are there all across the maturity spectrum from the short to the long end.
Now, isn't China, through their Belt and Road Initiative and now the 2.0 version of that, doing lots of yuan-denominated debts to all those nations?
They are, and those are extensions of credit, right? And the extension of credit is an effort for China to get countries to pay them back in renminbi over the medium term. That does introduce that currency into the capital markets, but there's no Chinese currency repo market, and there's no Chinese currency convertibility across borders either. So it is the extension of credit sliver of the pie, but that doesn't make it into a robust capital market that's equipped to handle something like maturity transformation.
Understanding the Chinese currency is difficult because there's two of them, right? You have the yuan and the renminbi, and understanding how they use those two is interesting. I want to get more into that, but before we do, I want to kind of build this case up a little bit more first. And so you had said, uprooting the critical financial infrastructure would prove lengthy, costly, disruptive, impractical, and there's no clear reason for another national currency to displace the U.S. dollar. Per the IMF's website, they say for the most of the last century, the permanent role of the U.S. dollar in global economy has been supported by the size and strength of the U.S. economy, its stability and openness to trade and capital flows, and strong private property rights and the rule of law. So that's the IMF's website. So you said there's no clear reason for another national currency. Per the IMF, the U.S. has had this role because of those reasons: stability and openness to trade, capital flows, strong private property rights, and rule of law. But what happens when those are gone? So if we no longer have openness to trade, no longer have strong property rights, and no longer have rule of law, for example, unilaterally moving against oligarchs without any due process. Does that cause now per the IMF's reasons, that starts to lose the reasons, and then to your point, there's no clear reason for another currency. Does that start to then push the need for needing to do that or wanting to do that?
It's a relative game, Mark. And so when we think about the dollar as the outlet, it you have to compare the property rights to other places. Now, I know we're struggling to, let's just say Americans are struggling to fight for their rights on a state and a federal level. That's actually a tale that's as old as the American nation itself, where the people are struggling to protect the republic aspect of our form of government, right? Because in the way that regulations can come down and the way that regulatory bodies have evolved, we just have that constant battle. So that exists, but then let's just bring in the euro for a second. Just look at the euro. Do we feel that our property rights will be stronger in Europe relative to the United States? That's the key conversation. And let's not even try to compare the property rights in China and the United States. And really quickly on the Chinese currency, the renminbi is the name that they call the currency, and my understanding is that yuan or won is a more generic way to describe currency, and so they're interchangeable and they can be used interchangeably. But China, it's the unit of account is renminbi, and yuan is a word to describe the currency. So you can use both of them at the same time or interchangeably.
Okay. So when I'm looking at this, and again, I think neither of us, any experienced investor, trader, would never be trying to time things, right? We're just looking for directionality here, and so looking at the directionality of this, we can see a couple trends. One, obviously, we can see the dollar's percentage of GDP and FX reserves has been dwindling, but I mean it's still well over 50%, over 60% or approximately there. But what I'm looking at is like money being used as a weapon. In 2018, there was an article written on MSNBC by Left, and he said that the U.S. was now waging war on 1/10 of the world. I was looking it up earlier. The U.S. is sanctioning over 1/4 of the world's populations. And so, when you kick a country out of being able to use a currency, then what are they going to do? Go die? They just have to find something else. And so, like, when you have 1/4 of the world's people that now can't be in the system, then those people, like if I kick 1/4 of the people out of my party, they may go start their own party somewhere. But what I've been seeing, and here's a couple of data points I pulled, is I see Russia has now made yuan their reserve. 17% of their FX is now in yuan. The UAE is now issuing bonds in their own currency, so outside of the dollar. Egypt is issuing 500 million in yuan bonds, so outside of the dollar. Israel's diversifying their FX into yuan. And then we have China and India buying oil in yuan. But what it looks like to me, though, is all of those people are diversifying out of the dollar. But does it really matter? Because it seems like what's really at risk here is all FX reserves and not just dollar reserves. So it looks like they're almost diversifying for deflation or inflation in the currency, as opposed to what we saw happen in Russia was their entire FX reserves were just seized. So are they trying? I mean, does it look like they're not really protecting themselves against what the U.S. could crack down on, like what happened with Russia? They're really kind of diversifying currency risk.
Yes, that is for sure. The yuan will have a higher carry than the dollar will, right? For example, and so we see that people that are dollar investors will swap dollars for a foreign currency to buy bonds in that currency and hope that the FX movement doesn't go against them enough to account for that extra carry that they got going for the higher return bond. And it has a higher return because a higher expected return because it has a higher risk. And so when it comes to countries diversifying their reserves and holding yuan, we see that that can happen at the margin, and it probably will, especially for Chinese trading partners. There's no denying that. That will definitely happen. But if you see countries diversify away from dollar or the mix of their reserves and start to buy debt from, let's say, the UAE or other countries that are issuing their own currency bonds, a lot of that trade is done through the FX swap market itself, where the capital that exists to buy that bond is actually in dollars to begin with. And it's just swapped into the currency to buy that bond. But when it returns back into its maturity, it's an extension of dollar credit, actually, that allowed that bond to be issued in a foreign currency. And it's some bank that transforms the unit of dollars to that other fiat currency. So, yes, the yuan is gaining in terms of the way people are or countries are holding their reserves, especially trading partners with China. But it's not enough to make, it's not enough to start the transformation of the broader capital markets going in that direction. It's an alternative investment, right?
Yeah. And so if we break this apart, like medium of exchange and store of value, and kind of using this Chuck E. Cheese example again, I don't want Chuck E. Cheese tokens unless I'm going to play those video games. Russia was selling their energy in rubles, but nobody has rubles. And what is Russia going to, now they get rubles, but what are they going to do with them? Nobody accepts rubles. They're no good, right? Money must be saleable, right? It must be accepted. But to your point, if they're doing it in Chinese yuan, and China is the largest exporter in the world, well, that's a lot of Chuck E. Cheese tokens that could be spent at China, right? That could be used. But that would be the medium of exchange. Doesn't mean that's where their reserves would go. I guess. Would you break it apart like that? So, but then could they put their reserves into gold, like what they're trying to do right now? And so we'll use the yuan as a currency because, hey, we have trade imbalances there, and then we'll store our wealth over here in liquid currencies that we might use, but also maybe gold or something like that.
And that is how it's playing out.
Okay.
And that's not the recipe for a world reserve currency to develop. It's the recipe for the internationalization of a currency. And that's the process that China is going through right now. They're trying to internationalize their currency. They're nowhere close to making it a capital market, or let's say a deep capital market, and the reserve and the method for global reserves to be held. They're just not close, but they are internationalizing their currency, and they're doing that with trade and things like Belt and Road.
Yeah, they did. I also did see that they're making the yuan convertible to gold. Did you see that? So then that looks like maybe it has a little bit of a store of value play in it, where you could hold their currency and it's supposedly kind of convertible to gold, as good as gold almost.
I didn't actually see the news story about Chinese currency being convertible into gold, but it's not a peg, right? There's no peg to gold or anything like that.
Yeah, it's not pegged to gold. It's just convertible to gold at whatever that floating rate is going to be. They just announced the last 2 months they added over 30 metric tons per month. Which they didn't add that. So then what they did is they announced they have it. And then the question is, why did they just announce that, right? If they've already had it. These are just speculation. But if we keep going down this, you had said that regardless of whether you'd like to deal in dollars, if you're going to grow as a nation, you need to be utilizing the currency that is embedded throughout all of global finance. And then you said that as the world continues to decentralize, which I view as what's happening, you say that the dollar actually becomes more entrenched as that happens because of the adversarial dynamic where no nation will accept another small, relatively illiquid currency because it narrows the options available. And so the money must be saleable. They don't want to be stuck with some little small nation's money. So it's interesting that you say that. As the world becomes more decentralized, then the dollar gets stronger. Explain that dynamic.
Yes, so if the world gets more decentralized, you're less likely to see the euro take over all the countries in Europe, like let's say the Nordic countries, which still have their own currency, the Swedish krona, the Norwegian krona, right? The British pound, and the Swiss franc. Okay, so you have Nordic countries, you have UK, you have Switzerland. You have several strong currencies still in Europe, right? And you can throw in more fringe ones like the Polish zloty, right? Which are still relatively deep capital markets from an international perspective. And I say relatively compared to, let's say, emerging markets, right? The Polish companies and the British companies are as likely to use euro as they are likely to use dollars. But the smaller you go in terms of nations, the less likely you are to see them coalesce around a second or third place currency unless it's something that's directly regional and regional based, like how we will probably see Chinese yuan utilized more regionally in Asia, right? But from the global perspective, the lack of consensus of the second place player makes the dollar last in its first place for a lot longer than it otherwise would have if Europe or China was really making that charge. And that's why I keep bringing up the euro and the yuan, because that's what we have in the second place than third place. It's not even clear which one is second, because different metrics will, like if we talk about maturity transformation, the euro market is very advanced in that realm. The euro repo market is a well-developed market. China doesn't have any repo market that's globally based. They don't have a global capital market, right? Western banks don't traffic in yuan-denominated securities and engage in maturity transformation. But is China the nation making the biggest charge in internationalizing its currency? Yes. So you see how the second place isn't even clear, and it won't become clear. That's my opinion here, is that no matter what China does, you still aren't eclipsing the euro and the dollar in that battle. And that's the lay of the land as I see it. So you have these challengers, but because it's not clear, the dollar still reigns. So in Latin America, in Africa, Africa is a good place to think about, because we have China coming into various African nations, investing, lending, trying to increase the amount of trade between Africa and China. And then Yellen goes and addresses that this is a continent that we have to focus on as a nation in the West. So Africa will Africa will actually be the place where we can play this thesis out. And if you see Africa going full China, then I'm beginning to be wrong here, and you have to assess. If you see Africa resist going full China, with the West coming in and the United States specifically saying, hey, increase the dollar trade, and you don't think it's in response to what China has done over the last decade, it is. It's in direct response, because they see the challenger, right? And governments have to play the long game, 20 years, 50 years. And they say, hey, we need to come back to Africa because it's a battleground for the global reserve currency. And we can't lose that battle. So that'll be a great place to watch. And at the Bitcoin layer, we will be watching that closely.
Yeah, I want to get more into some of those questions I have. But before we dive into that, talking about Africa. So if we look at and maybe I'm wrong here, but some of this kind of going back to where we started about the liquidity and the banking system, the financial markets that we have, that the dollar has. And so if we look at like the way the internet spun up, it spun up really fast in the United States because we already had wired telephones. And it didn't happen in emerging markets yet because they didn't have telephone lines. But then like Africa leapfrogged and went straight to wireless, for example, right? And if we look at sort of the kind of the same dynamic, we're maybe already seeing that play out where Africa has already jumped onto digital currencies, kind of leapfrogging past some of this traditional financial payment network stuff. So I'm curious if it is, some of this backbone of this U.S. payment system, the dollar payment system, is because of the correspondent banking systems and stuff that they have. If going to something like a CBDC or some sort of a digital payment might be a way where we might see them leapfrog past the existing constraints we have and set up a new system much quicker and easier.
And that type of system would have to get legs. So it's proof of concept right now. And we talk about Bitcoin. Bitcoin is part of what is the leapfrog event that we're witnessing right now with mobile phones and digital money. Because the CBDC is not live yet in Nigeria, for example, but it's coming.
It's not live. So the Naira.
I thought that it was in more of a pilot stage right now, that it's not being used across the country. So, but you can correct me on that, Mark.
Yeah, I'm not sure. I don't know either. I do know that I've reported a couple times where they were trying to use the carrot first to incentivize people to use the e-Naira, and they were giving them discounts on cabs and pedicabs and stuff, and not enough people were moving to it. So now the stick came out, and I think they limited ATM withdrawals to $25 per day.
Right.
Unless they get the e-Naira.
Yes, so you're right, and so it's been live since late 2021, and it's the restriction that confused me. That yes, that they're restricting the withdrawals of the money, and that's happening in the CBDC form. I was assuming that was at the banking level. So you see Nigeria being one of the places where the adoption of Bitcoin is at its most fierce. And so, that battle is something that you're witnessing. And yes, CBDCs do help get, the technology going forward. But I don't see it materially affecting, let's say, the dollar being entrenched, because in the end, currencies that do gain traction are the ones that are going to be convertible to dollars, let's say in the beginning stages.
Mm-hmm. Yeah. I guess what I just keep coming back to is necessity being the mother of invention or whatever, right? And I like to say that we only move when the pain is high enough. And so, in the Western world, the United States or Canada or something like that, like why do we need something like Bitcoin? We don't have high enough pain versus if you're in Turkey or Venezuela watching your currency blow up, or in, Afghanistan where nobody can send you money, you kind of get it. Back to the Nigeria, when I was doing some research on that carrot and stick I was telling you, the people were saying, why would we use the e-Naira? It's the exact same thing as the regular Naira. It's just still going to keep losing value. Like, we're not going to use that. Why would we, right? And so the pain is high enough. But going back to that pain, if we have a quarter of the world under U.S. sanctions, not being allowed to use this payment network, and a lot of these are commodity-rich countries, talking about Africa, for example, and so when these countries, they can't deal in the dollar network, they got to deal in something else. And so maybe in the beginning it starts off very small, but they have to do something. What do you think they'll go to? I mean, try the yuan and see if that gains steam?
I think black market dollars are more the method that's used in those cases, where we see, like in Iran, you see black market dollars being, a store of value and something that people traffic in. So I think that's more likely. Bitcoin does fit that role, right? We think about, I think a lot of people still think that gold can fill the role of global money, But if gold isn't being already used in these countries that are restricting the use of dollars or where the dollar is sanctioned, then you're probably not going to. And I will provide an asterisk there, which is that oil for gold transactions are still happening between nations today. Like Iran and India have been transacting oil for gold in the past decade. I don't know the statistics on it, but that has been a trade that has been on. And so gold is still being used as global money in a small use case. Gold is not really being used as money in a hand-to-hand. It's more black market dollars in places that are sanctioned. I don't see yuan being used as money in the hand-to-hand way in nations where, let's say, non-Asian nations that are sanctioned by the United States. And we do see Bitcoin being used in those nations on the ground. And that's very exciting for the prospect of Bitcoin adoption and the prospect of Bitcoin to rise in the face of gold being an old money that works globally, the yuan being a new challenger that's trying to attempt internationalization. Wouldn't you say that Bitcoin is also attempting internationalization? I would say yes. And then you have the euro, which is a continent that will be biased to restrict Bitcoin activity because of their more restrictive property rights relative to the United States, where Bitcoin will thrive. So there's a lot of moving parts. I don't have any of the answers or even the predictions. I just calling it like I see it, which is that the entrenchment of the dollar is too deep, especially in the capital market and maturity transformation side, that unwind is not begun, even though other ramp up efforts are happening, including the Bitcoin ramp up, of which you and I both identify as one of the big glimmers of hope in this whole conversation as we discuss the death of the dollar or the non-death of the dollar and the internationalization of the Chinese currency.
Yeah. I think, the death of the dollar is definitely sensational and it grabs headlines. But as I kind of started at the beginning, the dollar took over from the pound, but the pound's still the third ranked currency. It's still there. So it hasn't really died. It just kind of starts to lose its relevance a little bit. Jumping to Bitcoin for a minute, I mean, you did say in this article that Bitcoin did process over $8 trillion in 2022. That's not nothing. I mean, it's growing pretty big, and that's a big chunk.
Yes. And
where does it stack up in the kind of rank of trade or globally?
I think it's hard to compare that number. So let's say, first of all, that number was debated when I put it out. That people said, hey, there's certain. So I took the number from Jameson Lopp, who put out a tweet with the statistic analyzing the movement of UTXOs during 2022. I think it was 8.2 trillion that was in the calculation that he posted. And others came back and they said, no, it's actually less. So let's call it several trillion. But even then, as we see these trillions transacted on the Bitcoin blockchain, how much of it is due to the simple activity of sending money or sending Bitcoin to and from exchanges as traders get in and out of positions? Arguably most of it, but that use case it's not apples to apples comparable to, let's say, GDP or FedWire, right? I remember a few years ago the amount of FedWire on an annual basis was somewhere around $750 billion, which is about, I think it was 760 trillion. This is from a few years ago, which would be 100 times the amount that was calculated for Bitcoin. So honestly, it's not a lot, Mark, but it's such a big absolute number that it goes to show you that we have entered the trillions when we're talking about how much is transaction. Now I know that between 1 and 5 trillion is transacted in the FX market every single day, every single weekday. So Bitcoin at 8 trillion for the year is also kind of small.
Okay.
Those are some relative numbers for you. But then if we look at, if we look at just the absolute number of 8 trillion, it can go to show you that, hey, this is probably the amount that gets transacted in all of FX in a week, maybe. And that happened on Bitcoin in a year. So it's impressive, but it should come with, some relative markers.
Yeah. Now, another piece you had said was liquidity. Back to this kind of $8 trillion number, you had said liquidity is what makes the reserve currency viable. And so you have to have a big enough market where you can have enough flow go in and out. And so on an $8 trillion a year, which sounds big, but in the scheme of things, it's very small, and it's not a big enough, not a liquid enough market to move big amounts of money in and out without swinging it wildly. Is that right?
Yeah, and you also have to think about the fact that Bitcoin isn't a cash flowing security, and cash flowing securities are at the basis of a lot of banking planning or just asset liability management, which takes place in the trillions. And so you can't see, we think about pension funds as one of the biggest buyers of fixed income, and when are they going to come out of fixed income into Bitcoin, and that's going to unleash some flood of capital. But Bitcoin doesn't have cash flow, and so it doesn't fit the eye of the asset liability manager. And it doesn't fit the eye of liability-driven investing strategies because it doesn't have that nature, doesn't have that characteristic, and you can't plan an actuarial basis. You can't plan on an actuarial basis for something that doesn't have those cash flows or that expected life even, right? Bitcoin has an infinity expected life. And so that doesn't fit the models of asset managers. So that's kind of also when we're talking about liquidity, we have to consider also the characteristics of the asset classes.
Okay. And then let's go into maybe let's flip it and say what would it look like if it was starting to transition this way. So you said that talking about the dollar being the king and having the global liquidity and Bretton Woods and 79 years developing this complex network, and you said, quote, this simply can't be displaced by just unplugging the USD cartridge and replacing it with the CNY one. So you can't just take this existing plumbing, I think is what you're saying, and pull USD out and then stick China in. It doesn't work that way. But as we kind of talked about with this leapfrog Africa example, could you potentially keep this one that just continues to get used less and less and less, and then have this alternative network over here that starts to gain steam? Is that possible? And what signs would we be looking at to see if that was actually happening?
Yes, and when we think about the e-Naira, so I just looked it up while we were talking here. The latest number is 3 million people, up from 1 million people in Nigeria. So you're up to 3 million people that are using the e-Naira now. But does the adoption of the e-Naira take away from the dollar on the net when we're talking about dollar versus yuan adoption?
Right.
I'm not sure that I see that link, and it would be a different conversation if we were seeing people in Nigeria adopting the digital renminbi, right? And which might happen, Mark. So that might be part of the internationalization effort of China as it goes to its trading partners and it says, hey, why don't you start transacting in digital currency with us, and you can hold it in your wallet, and we might even let you earn a yield on it. And that would be a game theory move for China to try to strengthen its position. We could see that type of aggression, and so that's also something that I'll be watching for. This is, again, it's a relative game, and if I can't see the pieces that are there yet, it's hard to speculate on the Chinese yuan coming in and being able to support financial plumbing around the world, right? Those pieces are just not there. If they're there in the next 5 years, we have to change the conversation.
When you say those pieces, the financial plumbing, it's not just the ability of the correspondent banks to send money between themselves. That may be the easier part. You're more talking about the financial markets around it, the debt markets, the bond markets, et cetera.
Yeah, like
That's what you're more talking about.
when big international asset managers start keeping a significant portion of their assets in Chinese denominated asset markets, like Chinese bond markets, for example.
Why do they have to? So what if these big allocators said, you know what, we don't trust the FX market. None of these countries are trustworthy, and so we're going to keep our money in commodities. You might, I'm sure you're well aware of Zoltan Pozar's work, where he talks about these countries storing their wealth in commodities now. Like, that's kind of the trend. And he talks. There was an article that came out this week. GM just purchased $500 million worth of lithium mine in the United States, and they're talking about how they'd rather store their wealth in that commodity than in U.S. Treasuries, right? And so, what if that trend continues, where these big capital allocators like GM or Sovereign say, "Whoa, we're not going to put it in any currency. We're not going to hold U.S. Treasuries. We're going to buy the commodity, the lithium mine, the gold directly." What about that sort of a trend?
That sort of a trend, I think, has been there for a while, and we think about companies that allocate to either their savings or to projects, and if they see the project having a better return profile, then they invest. But those projects that they're investing in, they're purchasing them in dollars, and one day they'll sell them in dollars too. So it's just another asset that they buy on the dollar rail. And commodities also don't have cash flow characteristics that can support the liability-driven investment world. So it's a potential allocation for certain participants in the market, right? We call that market segmentation. And in certain segments of the market, we'll see commodities be more demanded. But part of the reason that we wrote this article was to address some of the narratives out there from Zoltan Pozar and others that were headed more to, maybe a dollar breakup or more of a commodity-based financial system. We don't necessarily see that unfolding in that way, even though you can point to the lithium allocation or other countries making certain moves, like Russia and China, in gold-based moves. We see those moves happening. We're not blind to them. But they don't really change our thesis.
Yeah, and it's great nuance, and I appreciate. It was a great article, and I've shared it, and I appreciate it. And one reason why I like it is because there's certainly no doubt of sensational headlines talking about the death of the dollar, and people need to understand this is a very nuanced topic. And even if this is the case per Zoltan Pozar, it's not imminent, and it's not an event. This is a transition. But going back to that just a second, so what would it take for you to kind of change your mind? Like, what are the things that would have to happen? So, like, China would have to open up capital controls or open up their capital markets and establish like a trusted bond market. Like, what would have to happen in order to see that where you'd be like, wow, okay, this is starting to gain traction?
Yeah, fully internationalized currency that can be held offshore and convertible to currencies around the world. So that would be the number one step. The Chinese currency to become fully convertible and, a potential allocation for most of the investment world, which is just not yet because of the way that they have a closed capital account. So that would be number one. And then number two would be a globalized Chinese bond market, which they're trying, but it's in its infancy. And then a globalized Chinese repo market for its bonds, especially its sovereign bonds, and its sovereign bonds being auctioned on a regular basis and reaching, let's say, the $5 to $10 trillion worth of supply, and that market to be followed in a way where, you know how we're all watching the Fed? Why? Because when they move the price of money, all the price of the bonds move too. Right. And so when we'll be watching Chinese monetary policy because it just affects that many assets, and that many assets are stored. So those would be some of the pieces that I would look for.
Okay. And so they're working on the currency piece of it right now, but it doesn't seem like they're doing anything on those other two pieces. So as of right now, there's really not any positive or any big progress being made in that direction.
I would
by
say
any of these challengers, by Russia, by the BRICS, or by China.
That's right. That's
okay.
That's part of the entrenchment there. It doesn't. We can look at the headlines about trade happening in yuan. That doesn't shift the plumbing aspect of how the world financial system works.
Okay. Good. Let's jump topics for a minute. I got a few minutes left with you here. Something that you and I have talked about extensively. You've written a ton about on the Bitcoin layer, which is about the Fed and what they're doing with rates. I don't know, 6-8 months ago, you shared a chart with me showing, I think it was the 2-year yield and the Fed funds rate, and when it inverted, and maybe they'd stop raising at that point, which I think we're there now. They leaked that they had probably only raised 25 basis points, which they did. And on top of that, the BLS came out and changed the CPI calculation, which, doing nothing else, instantly could bring down CPI by a couple of points. Based off of those changes in the system, where do you see the outlook for rates from here on out? Do you think they'll pause from here? Do you see more rate hikes, or what do you see happening from here?
Yeah, I think that the disinflation is in, and that will be the trend of 2023. So the trend of 2022 was really hot inflation and an active monetary policy response. The trend in 23 will be the disinflation trend continuing, and the Fed allowing itself to step back. It means not doing much. And so right now the market has one more hike priced in for 25 basis points next month. We still have a lot of data between now and then, but really what we're looking for is this trend that the fear last year, the fear of runaway inflation, that fear has ended. Now we're in a stage in which we are basically trying to assess how quickly do we come back down to longer term 2% inflation and that kind of stuff. So I know we talk about changes in the CPI, but really look past the CPI and look to the prices of commodities, the prices of food, the prices that we're seeing really across the survey components of PMI surveys. So like prices paid in ISM, prices paid in other PMIs around the world. That's it. We have enough inflation data from there to assess what inflation is doing. All of those metrics right now are telling us that the worst of last year's inflation is behind us. The Fed sees that, and they don't see the need to keep hiking. Now, they also don't see the need to cut, and I also believe that's my base case. That's what I felt for a while, that whenever they get to where they are, they'll be biased to keep it there for a lot longer than people think, and even if the economy gets weak. And that's really the last factor here, is that is the economy heading into a very bad recession, a shallow recession, or maybe avoiding a recession altogether? I think it's still a little early to call it on that, even though right now what we're seeing is the economy in contraction based off of the PMI surveys. But again, ISM services just came in at 55, which is well in the expansion territory. So right now, it is still a little too early to call any recession as well.
Yeah. Now, of course, 2020 showed the whole world that the economy does not equal the markets. We saw the entire economy shut down, businesses shut down, and yet the markets screamed to new all-time highs. And so we see those two are very disconnected. So, we'll see what happens with the economy. The data doesn't look super good. A lot of people say history kind of tells us that a lot of these changes the Fed has been making maybe don't show themselves in the market and the economy until 6-9 months out or longer. So maybe some of these moves have been so fast that we haven't really had time to digest them. And so maybe we'll start to see some of the results of those here over the next several months.
That's what we're thinking about when it comes to housing. Housing market has turned over, and prices are now going negative month over month. I think we're in, I wish I had the exact number, but I think it's around 4, 5, 6 months now of consecutive housing price declines month over month basis. That's based off of the Case-Shiller Home Price Index. It's the main metric that I watch on the housing market. And so those declines have come from the increase in rates that were happening 6 months before. So they're still raising rates now. So what is that going to have? What effect is that going to have on housing in 3 months from now, in 6 months from now? Housing is 25% of the U.S. economy. What does that do to the greater U.S. economy? So yes, monetary policy operates with a lag, and we don't see what happens fully from rate hikes until several months after the fact.
And it might have been 6 months ago whenever we had talked, and you had kind of had the contrarian viewpoint where there's no shortage of headlines out there talking about this big crash that's coming in the markets. You got the Harry Dents and the David Hunters saying there's another 60-80% drawdown coming. And you were kind of one of the first contrarians to say, I don't know if that's going to happen. I think maybe the Fed could pull off this kind of proverbial soft landing in the markets. Would that still be your base case for 2023?
Well, let's ignore the soft landing and just talk about the asset price.
Yeah.
The S&P 500 trades at 4,000. It's significantly above, I believe it's well over 10% off of the lows, and it is still well over 10% off of the highs. So you're in a consolidation range, and we don't see any. Well, when the stock market unwound in 2022, it bounced and has consolidated. So there has been no crash yet, and I really just always go back to the price and looking at the consolidation right now. I see a stock market that is in decent shape, technically speaking, and that's really the outlook I have for the stock market there. I see rates trying to put in a top and stocks trying to put in a bottom. That action has been trying to unfold itself, honestly, since June. But then we had, of course, another test of the lows in stocks in the fall-winter time horizon. But that's kind of the way that I still see it. And I do believe that the stock market will respond well to the Fed saying, we like the disinflation, and we're going to continue to watch that and sit in our position.
To a pause.
That's right.
Yeah. So historically, pauses have been bullish for stocks. Pivots, not so much. Pauses have done good. And so you're thinking that maybe there's a pause, potentially another 25 basis point hike, and then just kind of like a sit and wait, which would be a pause. And that would probably be at least somewhat neutral, if not maybe potentially a little bit bullish for the markets.
And Mark, I'll say one last thing on the 10-year yield. 10-year yield trading between 3.5% and 4%. That's actually kind of fair value for what I'm looking at. So I'm usually the treasury bull here, thinking that rates are going lower, but I don't see a lot of impetus in the market to get 10s down to 2.5% right now, with the way that growth is kind of hanging in there. Even though it's contracting a little bit, it's not falling off a cliff, and we don't see We don't see some of the biggest red flags. And a 10-year yield crashing would be one of those big red flags. So I watch yields to tell me right now yields still above 3.5%. Say economy is decent enough, and I try to read the prices to tell me what's going on.
Do you think that some of the Fed's like really fast, swift action might have been to buy themselves some room to maybe come back down a little bit when needed?
It's part of their academia, actually, where they say we raise rates so that we can cut them, and It sounds hilarious, but if you read their speeches from 2015, 2016, when they were raising rates back then, that's what they said. Yeah. We're raising rates so that we can cut them if the economy slows down. So it's definitely part of it, but it's a little simplistic to categorize that as one of the main drivers, but it's definitely there. They need room to cut if things go badly, and so the more they hike, the more they can accommodate when things slow down. And when better to overhike than when inflation headline is at 9%. So that's what we saw from them in 2022.
So for all of our, let's say, potential home buyers that got in at these 7% rates, do you think there might be a chance at lower rates coming in the future somewhere?
Yeah, that people will get to refi lower. I'm not too worried about that.
Yeah. Okay. Well, man, that's good information. We're going to go ahead and wrap it up with that, Nick. I get a lot of information out of the newsletter, The Bitcoin Layer. I read it all the time. I'm a paid-up subscriber. I talk about it a lot on my channel, and if you guys want to get that information, The Bitcoin Layer, check it out. We'll link to it down below, as well as Nick's other stuff on Twitter, Time Value of BTC. And check out the book, Layered Money. Anything else you want to call out, Nick, or that people should be paying attention to?
No, follow along at thebitcoinlayer.com. We're putting out newsletters and videos, so we hope you guys will follow along. Mark, appreciate you having me on. Thanks a lot, dude.
Yeah. All right, Nick. We'll wrap it up with that. Thanks so much. All right, that's a wrap. Hopefully you enjoyed this conversation I had with Nick. He's a great guest, someone that I use his research of a lot. You should check it out. There's a link down below. As always, let me know what you think. Give me a thumbs up if you liked it. If you don't, you can give me a thumbs down. That's okay, but at least let me know why. And hit that subscribe button while you're at it. And that's what I got. To your success. I'm out.